Very good evening to all our viewers. Thank you for joining us tonight on the agenda. My name is Taiwan Jabela. Tonight on the platform, we are joined by Martin Inkumbi. He is the CEO of the Government Institutions Pension Fund, GIPF as we all call it. And he's here to help us understand some of the issues that have been covered in the news lately, impairments of some investments by the fund, as well as the general business of GIPF. Thank you very much, Martin, for making time. It's a pleasure to sit with you. Maybe if you can engage us first and foremost about, maybe in summary, the state of the fund right now, in terms of asset values, in terms of your ability to execute your mandate, in that line.
Thank you, and thank you for inviting me. The state of the fund, GIPF is in a very financially sound state at the moment. Usually the soundness of a pension fund, especially a defined benefit pension fund like GIPF, is determined by what we refer to as the funding level of the fund. Now, the funding level is a measure of the comparison between the present value of all the future liabilities of the fund, which is normally the pension benefit that the fund has promised to its members, against the assets of the fund. So ideally, the total assets of the fund should exceed the present value of the liability. And that is independently determined by the actuaries of the pension fund. Usually on a periodic basis. In our case, this is done every 1.5 years. In between, we obviously do our own internal valuation. So according to the latest valuation then that was done by the actuary as at March 2025, the fund has a funding level of 119.6
billion.
No, that is the funding level.
That's
the funding level. Basically, you could call it, you can say 119.6%, meaning that the assets are exceeding the liabilities by about 19.6%. And that's a very strong position to be in. I think it's one of the highest funding level globally for any pension fund for that matter. So yes, in terms of the fund's ability to meet future obligations, we do not foresee any challenge in the medium term. Obviously, market movements can happen that can impact the value of your assets, and that could bring the value of the assets down, and that could change the funding ratio. But for that, there are also other measures. That is, you invest and you manage your assets that you need to take into account to safeguard the value of the assets. So that's where GIPF is at the moment. And it has been doing quite well over the years. And I can actually say over the past 17 years, we have seen strong growth. And that has led to the funding level I have just talked about. The value of the pension fund has grown from 35 billion in 2008, and it was measured at with the audited financial statement in March 2025 at 183 billion. We know now it has clocked over 200 billion as at the end of November. So we have seen good momentum and good growth over that period.
The assets, like in that case, is it confined to membership contributions, or does it include your own investments? Because you have also done a lot of good things with that money to accumulate assets in the likes of Capricorn, your Mashare Blueberry initiative and other things. Is it inclusive of all those things, or is it measured particularly on one thing only?
Well, the asset comprises of various asset classes, and I can touch on that a little bit more. But maybe before I go to that, The process really starts with a clear understanding of the liabilities of the pension fund. And this we also use experts to help us with that, actuaries. Looking at the membership you have, both those that are already in retirement and those that are still in employment, looking at the various demographic variables, age, gender, and then life expectancy, and then also looking at the pension benefit that has been promised. Remember, every member, especially those that are still in employment, at any moment, the future liability or what that person is entitled to when they retire is already known. So knowing all those variables, actuaries can then determine that these are your liabilities now, and that's how they will move going forward. And therefore, for you as a pension fund to be able to meet those liabilities, you need to have so much assets, and also you need to be growing your assets at a particular rate for you to be able to meet those future liabilities. The primary indicator of the development in future liabilities is the inflation in the country, because the objective of the fund is to try and increase the benefit, the pension benefit paid to members by inflation. So on that basis, therefore, our investment strategy aims to earn a particular return that is inflation linked. So we refer to it as the Namibian Consumer Price Index plus 5%, so CPI plus 5%. That's the kind of average return we would like to achieve in the medium to long term on the assets of the fund. And therefore now, once you know that, then you also look at your total assets and you need to develop a strategy how to allocate those assets in terms of how to invest it in which instrument, across which markets, for you to be able to achieve that return overall on your portfolio. And that at the moment, that CPI plus 5 is about 9%. Which the fund has been able to achieve, whether you're looking at a 1 year, 3 year, or 5 year period, and even over that 17-year period. And that is net of this reported cumulative impairment of 1.5 billion. So the idea is that the return on your investment should, net of the impairment, should match or exceed the return target that you have set for yourself, which will enable you to meet the future liabilities. So all this information are available. They are obviously contained in our integrated annual reports, which are published on a yearly basis, and they are also shared with our key stakeholders, be it the key participant employer, which is the government, and our Ministry of Finance, our regulator, NAMFISA. So this information is available. So you were asking about the composition of the assets. I talked about that currently the fund has clocked about 200 billion as at the end of November. And those assets or those investment is invested in various asset classes and in various markets. Predominantly, the bulk of the investment, about 90%, is actually in what we refer to as listed instruments. This will be listed shares on stock exchanges, locally in Africa and obviously globally. And then about 10% is in what we call alternative investments. This will be investments that are not so listed on stock exchanges, but are direct investments. And there are different classes in there: private equity, private credit, venture capital, etc. And that is the one class. So if you were then to look at the investment portfolio, that you will find that the majority of GIPF's investment is in listed equity and in listed fixed income instruments, government bonds issued by various sovereign governments, including Namibia. And at the moment, about 45% of the GIPF, 47% of GIPF assets are actually invested in Namibia, in Namibian assets. Government bonds, other fixed income instruments issued by Namibian institutions, and also equity on the Namibian Stock Exchange, including of course alternative investments in the Namibian economy as well.
Does that mean the other 53% is invested elsewhere?
Yes, it basically that means if we're saying 45 or 47% in Namibia, 53 is outside.
Yeah.
Of that, 35% is international, and the balance, which is about 16% at the moment, is in South Africa predominantly, and a bit in Africa as well.
Okay.
So if you were to look at the split, it's really predominantly Namibian, 47% at the moment, 53 elsewhere, but that 35% is internationally, Europe, the US, China, and other markets, and then about 16% in the South African market.
I see. Tell us about the governance architecture of GIPF. Can it be classified as an SOE?
Well, strictly speaking, GIPF is not an SOE. However, it's a body that is established by statute. There is a GIPF, it's established by statute. But it's not really an SOE because it's a membership-based organization. Yeah. You can actually say GIPF or the assets of the fund are owned by its members. And therefore it has got a board of trustees that, yes, are appointed by the employers and also by the member. The employer being the government, which is the key participating employer in the pension, in the fund, because the majority of our members are civil servants, or those that are retirements were civil servants. And of the 9 trustees, government through the office of the Prime Minister will appoint 6 trustees, and the other 3 are appointed by the employer representatives, the union, NAPO and NANTU. So that is how GIPF is governed, by a board of trustees. And obviously the board of trustees have got board subcommittees that have oversight of various aspects of the management of the fund. Be it the investment subcommittee of the board, comprising of some trustees that oversee the investment policy and investment strategy and processes of the fund. And then obviously you have your audit and risk committee, you have your HR committee dealing with HR related issues, and other subcommittees. And on these subcommittees, the trustees have also co-opted technical experts who are not necessarily trustees, but these are experts in the industries, whether it's in investment, HR, auditing, IT, that are co-opted in this trustee just to give that technical expertise and enhance the capacity of those subcommittees to execute their functions. So the fund really operates in a highly regulated environment, starting from the Pension Fund Act, which lay out what exactly a pension fund can do and cannot do. So, and then obviously the regulator, NAMFISA, which also issue regulations and directives and actually do audit and expect reports in compliance from all pension funds, including GIPF. And then internally, we have our own policies as well and risk management parameters that we have put in place.
When you spoke about a defined benefit fund, what does, in a layman term, mean, and what is the opposite of that?
All right, it's a good question. The opposite is what is referred to as a defined contribution pension fund. So, in the majority of pension funds in Namibia, perhaps globally, are actually defined contribution pension funds, meaning they are very close to a savings scheme. So, employees and the employer, in the case of a defined contribution pension fund, are making contribution on a monthly basis to that fund, and obviously that fund or those investments are managed and invested by investment managers, and they grow. And at the end, on retirement, that is what the member or the employee will get. So,
do I get out what I put in?
You get what you put in, what your employer has put in, and also the return that those assets from you and from your employer has has gained over the years. That's what you get. And with that, you can either, in some cases, you can take it in cash on retirement. But in most cases, you can actually buy a retirement annuity. Now, the difference, on the other hand, is the defined benefit pension fund like GIPF, where there is a promise that on retirement, on the basis of the number of years that you have worked, your average annual salary at retirement, this is the pension that we can pay you on a monthly basis. And that is for life in the case of GIPF.
Okay.
And that's really the main difference, that in the case of a defined contribution, what you have put in and what your employer has put in is what you get. If it's not enough to take you to the end of your life, that's it. In the case of a defined benefit fund like GIPF, there is a guarantee that you are guaranteed a certain benefit for life. And in our case, that's also on average increasing with inflation.
Oh.
So there is almost a commitment from the key participating employer also that when there is a serious shortfall, they can actually then come in and make good of that shortfall.
Wow, wonderful. Okay. Now let's get into these issues that were in the news. One of them is that GIPF recorded significant impairments in its investments, including 815 million offshore investment now classified as impaired due to a tax dispute with SARS in South Africa, the tax revenue agency there. Engage us on what transpired here.
All right. Before maybe I go into the details of this specific impairment, let me talk about maybe just to make sure that maybe there's an understanding of the terminology used. It's an accounting terminology. Loss or impairment. In a day-to-day engagement, these terms are often used interchangeably, but there is a difference. And there are similarities in the sense that they both affect the profit of an organization. A loss is usually where an investment has completely been lost. The amount is known and there is no opportunity for any recovery, and that is written off against the income statement or against the profit of an organization. An impairment has got a similar impact, but there is an opportunity to reverse that impairment. Maybe a good example could be if a business owns a building and due to a storm, the roof of the building is blown off. Now that building was worth $1 million before the storm, and then after this, the damage to the roof, valuators come in and say, look, your building is now only worth 500,000. But of course, if it's repaired, the value can go back. So in that case, then you can write down the value of your asset, but it again also reduces your income. But when there is an improvement on the building, the value can be reinstated. Similarly, also when there is movement in market sentiments about property values in the economy, evaluators come, they value the building, and they find that the value has moved from 1 million to 500,000. That's what you can sell it for now because of market development. In your incomes, in your balance sheet and income statement, you also need to write down that value from 1 million to 500,000. And that other 500,000, you write it off against your income statement. Market improves, the value goes back to 1 million, you reverse that. So that is really the main difference between a loss and an impairment. Hopefully, it's a bit more understandable, but they both have an impact and an adverse impact on the profit of the organization, except only that one can actually be reversed, while the other one is a permanent write-off. So now, in recording the assets of an organization, and in this case, in the case of GIPF, it is expected that we should record the assets at their true and fair market value, so that we do not misinform or misguide the readers and users of the financial statements. So in a case where information have come to a fore that a particular asset's value has been decreased due to certain development, it is expected then that we need to indicate or record that asset at the current fair market value. And in that case, then you the difference between the higher value and the decreased value is your impairment, which of course reduces your income statement. But there is always that opportunity to revert it when new market development has happened that actually restore the original value of the asset. So I've talked a little bit more about the impairment versus loss. Now, specifically on this particular investment, which is reported, the GIP investment in this one particular fund, Signal Structured Finance Fund in South Africa. Maybe it's a complex transaction, but I can simplify it, but also without going into finer details, because there are specific steps that GIPF is also taking to recover its investment. And because of that reasons, we are limited in terms of what we can disclose in public. But what it is basically that GIPF, through this particular fund managed by a fund manager, invested in a company in South Africa. This was around about 2021. But this company has been in existence for a couple of years prior to that. And way back around about 2016, this particular company was involved in a transaction where this company earned revenue on which it didn't pay tax, perhaps because they under the understanding that it's not taxable. And then around 2022, 2023, SARS comes and say, Company X, that particular transaction you did, 2016, it's actually taxable. You should have paid this amount of tax. You didn't pay it, and therefore you owe me that tax, and you didn't pay it, so you were in default, so there's a penalty, and because you owe me that amount from that period, I'm also charging interest. So that is how this huge tax liability or claim by SARS came about. Of course, the company is disputing it, and that dispute is ongoing. Now, in terms of proper financial reporting, I've explained earlier that a business is expected to report the fair value of its assets. Because now, around 2023, 2024, we became aware of this claim while it's still being disputed, but to be prudent, because it has got significant impact on the value of the company and our investment, we have then to report and record that investment at fair value, taking into consideration what if SARS is successful, and then significant value of our investment will be eroded, and therefore we have to impair it. That is really what it is. As I said, of course, it is still being disputed. It could well be that if the company, if the ultimate position or decision goes in favor of this particular company, we will reverse that impairment. If not, of course, we have then prudently reported that it could potentially be a loss. That is what it is. But even if then that happens, we are, as a fund, still taking steps to ensure that we claw back on our value.
Yeah. I mean, in a situation like that, Mr. Inkumbi, how does one, what latitude do you have to pursue a matter like that? Because it sounds as if this entity now, if things don't go its way and it loses that money, what recourse in law do you even have?
Yeah, well, that is the specific area or space that I do not want to discuss at this moment, but we are looking at various options. Yeah, maybe what I can say about that specific transaction, because there has really been a significant outcry out there and some have taken out knives, but we are not aware at GIPF of any governance breaches or policy breaches or process breaches on the part of the officials of GIPF or even the trustees. It's one of those isolated occurrences. We have not really experienced it before, but we have taken a couple of lessons. I mentioned that it's quite a complex transaction, And there's a couple of lessons, and we are taking measures to avoid that going forward. And we are also in the process of divesting from this investment. It's just one, but it's basically a portfolio of other asset classes as well in there. But we do not at this moment foresee major challenges with the others. It's only this one particular investment.
Yeah.
We have also done an analysis of this investment from the time it was made and up to recent times, and it has earned a return, the total portfolio, net of this particular impairment, have still earned a return of about 7.7%. It is about 2% falling short of the CPI plus 5 that we are targeting just because of this one particular impairment.
Yeah.
Was it not for the impairment, we would be slightly exceeding the target still just on that investment as well. So we hope if touch wood and there is a reversal, it will still possibly end up being a good investment.
And speaking of lessons learned, is due diligence one of those?
Yes, due diligence is one. Maybe the other is significantly the type of investment structure. Maybe that we in future need to avoid complex investment structures that have limited see-through on the ultimate assets that you have invested in.
Absolutely.
Yeah.
We go for a very short break and return with Martin Inkumbi, CEO of GIPF. You are watching The Agenda, and we are engaging GIPF CEO Martin Inkumbi. Now, Mr. Inkumbi, the subsequent to this media report about the 815 million investment that is at risk of being lost, I think I saw another article. I thought I had it on my notes here, but I don't have it. But there was another article, I think, in the Namibian newspaper that talks about, I think it said 1.5 billion or something that must have been lost, I think, since 2018 or since 2008 or something like that.
Yeah.
So if the fund has been very careful about where to put its money and all that, why does it accumulate to so much money?
Yes.
And it's one economy like ours.
Yes. Well, yes, it is correct. The report is based on the impairment report of the fund, and it's also reported in our audited annual financial statements. And indeed, it is the cumulative impairment over that period of 17 years, 1.5 billion. And it is basically the cumulative provisions, because investments, these are living assets. Sometimes you make an impairment on the basis of the information that are available, that the value has gone down, but since it's an impairment and not a complete loss, there is always that opportunity for a reversal. Now, the figure of 1.5 billion as a quantum figure is significant. Especially in the context of our economy. Of course, in the context of the total portfolio of 183 billion at the time that this 1.5 billion is reported, it is still a relatively low number as a percentage. Now, when you are investing, you always need to have a target of how much impairment or loss can I tolerate without compromising the sustainability of the fund. Now, and that's where this figure of 1.5 billion in the context of the total investment portfolio does not compromise the sustainability of the fund. Now, and I need to be very careful here, because that's where I think my responses to this question were misunderstood. The question often asked is then that this impairment, whether it's the cumulative 1.5 billion against the total asset portfolio, or whether it's the 815 in this one particular investment, does it compromise the sustainability of the fund or the ability of the fund to meet its future obligation? And the answer to that question is no. Is it a significant impairment, specifically the 815? The answer is definitely yes. That's why we said we are not taking it lightly. We are taking lessons, and we are also taking steps. So I think my response here really need to be understood that we are not trying to play down the magnitude of the figure, nor are we sitting back and not doing anything in terms of what are we going to do going forward to avoid or to limit such occurrences, and also what are we going to do to try and recover by reversing that impairment. There are steps we are taking. So, but the answer to the question on how does it impact the fund's ability to meet its obligation is that it is not a significant loss to compromise the sustainability of the fund at this stage.
How does this 815 million impairment differ from the DCP issue of many years ago, where 660 million, if I remember the figures correctly, was disbursed through different local entities, and a number of them in a similar fashion, and maybe the reasons are different, but they also failed to return that money to GIPF. If you want to categorize these things, is there any distinction really between this and DCP?
Well, I maybe must say that since the DCP happened before my days, I may have limited information on the DCP in comparison to this. But to my understanding, yes, there are some differences. Now, DCP happened during the era when GIPF was making direct investment in enterprises. In other words, a business would requires capital, they approach GIPF, and through a due diligence process and approval process, an investment is made directly in a business by a pension fund. The fund has moved away from operating that way a couple of years ago since the happening of DCP. The fund took a position that it will no longer invest directly into enterprises. It will rather give mandates, in other words, money to investment managers who have expertise and who have got the time and understanding of various investments to manage those investments on behalf of the fund. These are discretionary mandate by and large, meaning that a fund manager, on the basis of their expertise, track record, are given a mandate over a period of time, and they are to invest that money in a particular class of assets as determined in the mandate agreement between that fund manager and GIPF. So that is how it works at the moment. So therefore, that's why, in my view, the level of impairment, beside now the occurrence of this particular incident, which has got its uniqueness, have relatively been low over the years compared to the losses that we experienced during the DCP period, because GIPF have moved away from investing directly and rather trusting experts who have the time and the experience and the closeness to the market to manage investments. So that is the difference between the DCP and this current impairment, including the 815. Yeah,
absolutely. What can you tell us about your investments here locally? Some sound lucrative. I think Capricorn, I think you have some stakes there, and it's really a thriving business.
Yes.
But we have the Mashare berries, for example, which is listed as one of the things that are giving you some sleepless nights. What are the issues at this blueberry project?
Okay. Well, firstly, I will probably not want to dwell in the specifics of the impairment for each particular investment. These are governed between agreements between the fund and the third parties, and maybe it will not be an appropriate platform to divulge everything here in the media. But I'll talk about the general GIPF investment in the Namibian economy, and then specifically in the alternative investment market, and then also the unlisted investment for the purpose of Regulation 13. I mentioned that at the moment the fund has invested about 47% of its investment portfolio in the Namibian economy. A significant part of that will be in fixed income instruments, government bonds and other bonds listed, and also in the listed equity. So the largest portion is in that. It's a smaller percentage, about 7 billion, is in alternative investments here in Namibia, and only a very small portion of that is actually in the Regulation 13 unlisted investments. Now, and that is where the likes of Mashare and others are falling in that class. You talked about good investments that GIPF has in Capricorn Group, FNB, many other large corporates in Namibia that have been doing very well. But of course, then as a pension fund, in terms, because of the regulatory requirement that the fund need to also invest in almost, I could say, greenfield enterprises, and for the right reason. And I don't think it's only done because of the regulation requirement, but as a pension fund and a significant investor in the economy, we also need to put our money where our mouth is. So therefore, there is also this direct investment in Namibian enterprises, some of them really startups, to help them grow, because that's how you expand and deepen the economy and create employment. I don't think it's something that we can and should run away from. We just need to learn how to do it better. Both parties, GIPF, the fund managers, but also the investee companies or projects that are the beneficiaries of this pension capital. So we simply need to learn how to do it better, and we at GIPF are taking certain steps towards that. So yeah, so the likes of the project Mashare you mentioned and many others that are reported in the media, because obviously this media house happened to maybe have a report of the impairment report that management have submitted to the board. They are enterprises that are there. They are businesses that are still operating and ongoing. Now, especially startups, they go through what we refer to as a J-curve. When they start, they go through a moment of low performance, but they still have time to catch up and earn returns and growth for the fund. Now, what happens typically is that when you make an investment in a project, 100 million, for example, it can go through a moment where it loses a bit of value because of operational expenses, revenue is not coming in. So you have invested 100 million, but in 2-3 years, the value goes to 80 million, 70 million, but then it can pick up as then the business grow. So as long as there is that time and there's fundamental grounds for that business to grow, there's always that opportunity that the value of the investment can increase to earn a return to the fund. So some of those impairments are really temporal adjustment in value because of the great J-curve effect. Yes, there are some that have fundamental challenges, and those could also end up being realized losses at the time when the fund divests from that investment. But talking about alternative investment and specific unlisted investment, we do alternative investment in international markets, in that South African market as well, and locally. Now, over the years, if we analyze the impairment on the unlisted investment, they have been significantly higher in our Namibian exposure than in the international market or in the South African market for that matter. Yes, we had this blip, this incident of the 815, but that is a unique occurrence in a long period of time. But in Namibia, we have had these challenges for quite some time. Only that our investment here has been small, and perhaps the quantum of the impairment has been low. But it's due to a number of factors that we have looked at, and as I said, we are taking some steps to see how we can improve on that. One is, how do we strengthen our both due diligence and portfolio risk management capacity in-house in GIPF, in our investment department. The other is also, how do we capacitate our local unlisted investment managers for them to gain skills and experience in selecting winners, in managing those investments, and also to strengthen governance. We have also experienced that a number of losses has happened because of poor governance in the case of some investment managers, to the extent that some of them have even had their license revoked by NAMFISA. So there are those challenges in the local economy that we need to look at and see how we can improve, both from GIPF side, from the unlisted investment manager side, the local ones, and also the investee company, how they are managing their enterprises and the capital they have received. So it's really an effort that requires input from various angles, because as I mentioned, I don't think we can walk away completely from investing in the local economy and also from investing in unlisted investments.
Yeah. One of the issues that your members are demanding, Mr. Inkumbi, is for them to access financing to acquire homes, houses. And there was this big announcement by GIPF that they have heeded that call, and that a plan is now being set in motion to make that a reality. But my understanding of, upon close scrutiny of what you are proposing, and I hope I'm wrong in my interpretation, is that your members will now have access to their finance, which is with you, in order to be able to use it as a guarantee to still get a home loan from the bank, when in fact their demand is that we don't want anything to do with banks. If I have 3 million worth of pension with GIPF and I stumble upon a house worth 400,000 in Onipa, I should be able to access 400 million from my pension instead of going to the bank again and be subjected to all those terms. What is the real story here?
It's a very good question, and maybe a bit of correction or clarity there. This scheme, the pension-backed home loan scheme, is not working through commercial banks. It's directly with GIPF. So although obviously we have appointed administrators to do the admin work, but the member will not need to go and borrow from a bank, and then the pension provide a guarantee. They are getting the loan directly from the administrators who have received capital from GIPF for that purpose. So a member is actually directly borrowing from their pension fund. And
but that third party that you're talking about now, the administrator, is it not just another replacement for a bank?
It's a good question. No, it is not, in the sense that this administrator is not charging interest. They are not earning the interest. There is an interest being charged, and I'll explain the rationale why is GIPF then saying pay back what you have borrowed and also pay interest on it, which is also not always received favorably in some quarters, but let me touch on that a little bit later. But in terms of the relationship between the administrator, is simply because this will be a lot of, there will be high volume of transactions, and GIPF being a pension fund, we don't have the capacity to do that admin work in addition to administering our own pension payout and investment management. So we then have appointed these two parties at a fee which is paid by GIPF and not paid by the member, and the interest that is being paid is coming back to the GIPF, and it's coming back in the pot of that member. So now, just going back a little bit about the background to this pension-backed home loan scheme and what have led to where we are. Firstly, starting with the Pension Fund Act. The Pension Fund Act stipulates exactly what a pension fund should do. And the primary objective or activity of a pension fund is simply collect premium, invest those, and give members their pension benefit, which is primarily the pension annuity. When you are able to do that adequately, only then can a pension fund consider providing other benefits to members such as funeral cover, etc. The primary objective is just pay the pension benefit. Now, of course, over the years, there has been an outcry and saying, well, we want to benefit from our pension money, not only in retirement, but can we also benefit while we are still alive, while we are still working? And hence, there has been amendment made to the Pension Fund Act to allow that, and specifically only for housing purposes, either to buy, to build, or renovate, or matters relating to improvement of a house. So that has been permitted, and it's not only for GIPF but for all pension funds, and GIPF has then thought it wise to introduce a program where, without compromising the livelihood of members in the long run when they are in retirement, to allow them access to a portion of their pension benefit account for that purpose. And hence, we have set it at 1/3, that you can access 1/3 of your pension benefit at any moment for that purpose. We then also saying, and this is also in the Act, it's actually required that it must be by way of investment. In other words, GIPF is not permitted to give it as a grant. We have to extend it as an investment. That's what the law says. So, and therefore, it's an investment to be repaid, but also to be repaid with interest. So, firstly, we need to comply with what the law requires as a pension fund. But secondly, there is also a rationale and a reason behind that. And the reason is really to say, can we try to help this member acquire a house, improve on their property, but still restore their position when they go in retirement through them paying back, and also with interest, so that their portfolio can grow and they will be able to draw a reasonable pension benefit. That is what the scheme is all about and how it will be operating. Okay. In the case of this member not being able to pay, they just forego the 1/3 on retirement.
Of what remains?
The 1/3. Remember, the pension, they only take 1/3.
Yeah.
2/3 is still there for them to get a monthly payment. The 1/3 is usually what a retired member gets as a lump sum payment. Yes. Now, in this case, when they have used it to buy or build a home, but for one reason or another, they have struggled to repay it, on retirement, they can still get the 2/3, but in terms of monthly pension annuity. But the 1/3, the lump sum, they will forgo. But at least they have a house. So there will be no incident of the repossession of such house because they go with their title deed. They will have their title deed at home.
Okay. Yeah. I like that. It's a brilliant formula. I really like it. And thank you for correcting me, because really I think I was engaged in a very heated conversation with friends on social media, and my conclusion was exactly what I thought was the case, that no, you must still go to commercial bank with a guarantee, with your money as a guarantee for the bank to still give you money, when in fact what you don't want is bank loans. Yeah, maybe as we draw towards the conclusion of this conversation, Mr. Inkumbi, let's venture a little bit into FIMA, the financial, what is it called?
Financial Institutions Markets Act.
Yeah, yes, that one. One of the contentious issues, is that clause still there? The clause that preserves 25% of your, which only gives you 25% if I was to quit my job today, or has that been done away with?
Yes, firstly, well, I'm not the authority to speak on FIMA on behalf of NAMFISA, yes, or the Ministry of Finance, but our understanding and what we have seen is that clause is not there at the moment. So that has been parked for now. But the rest of the provision of FIMA will be implemented. From our side as GIPF, we have been studying FIMA for the past 24 months and preparing ourselves to be ready for implementation. Yeah. And we have no concern that as GIPF we will be able to comply. it will be a process. In some cases, there is a need to make amendment to the GIPF rules.
Yeah.
But where those amendments need to be made, we will obviously follow the process to make those amendments to enable us to comply.
What are some of the radical shifts that you may be able to, that will be required to embark on as part of implementing it?
Well, I think one of them is, for example, that the trustees or board of trustees of a pension fund should comprise 50% of trustees appointed by the participating employers, the other 50 by the members.
Yeah.
At the moment, as I have indicated earlier, GIPF is that 6 by the employer, appointed by the employer, and only 3 by the members through their trade union. So that is one of the shifts or the changes. The other one is the requirement for a shorter period for the submission of audited financials for a pension funds, for example, from the current 6-month period to a 3-month period. It's a short, very short period. We will have to see how do we start early and move at a pace such that we can comply with that. So those are some of the changes that really we see in FEMA.
Yeah. There's one last question that I forgot to ask you earlier when we were talking about this, the architecture and the governance architecture of GIPF, and you referred to essentially who owns the fund. If in some of your thriving investments you make profits and stuff like that, do you declare dividends, and if so, to who?
No, the fund does not declare dividends. All the earnings and the profits and the return earned are going into this pension fund pot. Ultimately, they are passed on to the members, because it simply means that once the assets of the fund has grown to a level exceeding certain threshold relative to the liability, the fund can afford to give higher increases for pension annuity, and even review some of the pension benefits and increase those. So indirectly, all those returns and earnings are still passed on to the members. They are never earned by anybody else.
Yeah. So in conclusion, Mr. Inkumbi, you can tell your members who have been looking forward to this conversation that despite all the challenges that you have gone through in the recent past, your ability to execute your mandate towards them, that one is intact.
Certainly, I can say that at the moment, given the funding level of the fund, GIPF is able to meet all its future obligations adequately. I think the performance of the GIPF team should really be evaluated over a bit of a longer period, and the status of the fund at the moment, as I mentioned earlier, that over the 17-year period to March 2025, the fund has grown by almost 150 billion, and that is net of the cumulative 1.5 billion impairment. It has earned a return exceeding or at least matching the CPI plus 5. The fund has been able to pay member benefit every time, on time. So I think the team has done quite well. We do take note of the current impairment experience, especially the single one of 815 million. I hope I have given a bit of clarity and context. It's not a complete lost case as we speak. And even then, we have also taken lessons and measures to minimize that. We have, together with our investment consultant, crafted a new investment strategy. We will see a little bit more increase in Namibian investments over the next 24 months, coming at the reduction of some South African assets. Global investment will probably be left intact, but we will see a little bit more repatriation of capital into Namibia. We will be looking at how we can finance local infrastructure. So that is the strategy of the fund going forward.
Absolutely. Mr. Inkumbi, it was an absolute pleasure talking to you. Please have a Merry Christmas. Take time off with your family so that on the headlines. Hopefully the headlines will be kinder in 2026, but thank you for coming through.
Thank you, Toivo, and Merry Christmas to you too, and Merry Christmas to our viewers and our members. We look forward to a prosperous 2026.
Absolutely. Thank you also for you, the viewers, for making time. Have a blessed Christmas and a prosperous 2026. That was today's show.